We have all been taught that the Fed's going to back up the stock market. If the stock market starts falling, the Fed's going to get in there. They're going to lower rates. They're going to say something for the stock market to go, okay, thank you. We're going to start going up. That has changed, and we have to talk about it. The other thing we have to talk about is what is starting to break. And there was a huge thing that broke this week that almost no one is talking about. In fact, I really haven't heard anyone talk about this huge break. And whether you live overseas or you live domestically in the US, something is breaking. And I've said before, in these periods of instability, watch for things when they start breaking because that's a sign of acceleration. Stick around and we'll get to both of them. Hey everybody, this is RC Peck, and this is my weekly Fearless Wealth video. There are two things we're going to talk about today. We're going to talk about something that has broken and why it is important to know. And the other thing we're going to talk about is the Fed not coming to the rescue. Now, even if you don't live in the US or you don't care about the Fed, this is going to impact you. And because it's going to impact the kind of the global direction of the overall markets. So let's do this. Let's first start with what is breaking, if not broke. So let me go over and let me share with you what is breaking / broken. So the Bank of Japan has been buying a lot of their own 10-year treasuries. And I mean like a lot. If you look at this chart over on the right of the chart, it looks like the edge of the price chart, but there's a line that goes vertical to basically between the 10 and 12 mark. And that's Japan, the Bank of Japan, increasing their purchases of their own 10-year treasury. So the question is, what has a country 6x the increase of their own debt? And the answer is when instability lands in a country. So this is what happened, and this is really interesting. So now this matters because Japan is the fourth largest. Is it the fourth largest? It's the third largest. US, China, Japan. It's the third largest economy on the planet. So Japan has said, we're going to defend the yield on our 10-year treasury, and they don't want the yield to go above 0.25. Now, if you squint, you can see this little teeny spike here where the price did go above 0.25. There's 0.25 where kind of my two blue lines are right there. And it spiked above and it freaked out the Bank of Japan. And they went out and they 6x increased how many of their own bonds they're buying. That's a sign of something either breaking or broken. And I've talked before, in these periods of instability, look for the signs of things breaking. That's a sign that instability is increasing, and that's going to give more direction to the downside move in the markets. And that is one thing that has happened and is happening. Now, this is an interesting chart. There's two lines here. There's a purpley periwinkle blue line, and there's an orange line. The orange line represents how many job openings there are in the United States, how many job openings there are. The purple line tells you how many people are unemployed. So let's say there's 6 million, I'm rounding, that there's about 6 million unemployed people in the United States. And rounding, there's 11 million job openings. Generally speaking, if you want a job, the job is there. Now, I'm showing you this to talk about the next thing I want to talk about with you today. And that is the Fed does not care what's going on with the stock market. Now, in the past, it cared, and people think it may. I hope they don't. People still think that the Fed's going to come to the rescue of the stock market. It's not. Now, there's a good reason why people think the Fed's going to come to the rescue. And the reason is because it's done it in the past. 2008 changed everything, the global financial crisis. Quantitative easing, which is really money printing, that started. And if you look at the screen, you can see everything the Fed did. Now, this is 2010, 2011, 2012, 2016, 2018, 2020, and 2022. Each one of those dates, the stock market fell. And the Fed did something to stop the falling. They either kept rates at zero, they lowered rates, or they printed money. Now, fast forward today, they're not lowering rates. They're actually increasing rates. And I believe they'll increase rates probably to somewhere around 3%, plus or minus 0.5%. Yes, that means somewhere between 2.5 to 3.5%. That's going to give the entire bond market a hard time going higher when the yield of the federal funds rate's going up. Now, so not only are they not lowering rates, not only are they not keeping rates at zero, they're actually stopping the money printing too and reversing it. So the Fed is not coming to the rescue of the stock market. Now that's been a huge kind of push underneath the market, and that is gone. This is important to know because markets tend to fall more when, the largest central bank on the planet is not there to protect it. And I don't see that changing anytime soon. And something's going to have to break. And that's why the theme of this video is kind of like instability. Something's breaking, or broken. That is the Bank of Japan really, really, really under strain. And then also the Fed's not coming to the rescue of the S&P 500 or the NASDAQ 100 or the Dow Jones 30 or the whatever, fill in the blank. It's not coming. It's on its own. And what's happening right now is people are repricing what they think a share of stock is worth to them. So we'll see, but it's probably not ended. I'm not saying it's the end of the world. Markets fall 50 to 80%. They've been doing that forever. This happens in developed countries. What you have to have is a strategy that it be okay when things fall. I don't mean like saying, oh, it will always come back, right? I mean, let me just pause there for a second. Has anyone ever felt good when their advisor has said to them, well, the market always comes back? Like any other industry, someone would say something like that would be horrible. Well, you're going to get really, 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 really sick, but you'll probably make it through. Now, how about we just don't get really, really sick? So conventional advisors, which I call big box advisors, they have these like sayings, well, the market always comes back. Well, I'm in the market too. Oh, so you're going to lose half your money with me and I'm paying you? It doesn't have to be that way. So as we end the first 2 quarters of 2022, by the way, both quarters are down, both in stocks and bonds, typically not a sign of stability. So you really want to start thinking about what's your overall strategy, because you own the strategy, not the symbols, right? The strategy tells you what to buy. Okay, let's land this plane. So the Fed's not coming to the rescue of the market. So that probably means the market's going to need to find its bottom on its own. And we are seeing more signs of cracks, more things that are breaking. Thanks, guys, for being in my world. I appreciate you. I appreciate you listening to the video. I appreciate you sharing the video, leaving comments, liking it. All those things help the algorithms. And let me know where I got it right and where I got it wrong. You do not need to suffer through. Now, we don't know what the market's going to fall, 30, 40, 50, 60, 70%. I started with 30, so it could fall just 30. It could fall as much as 80%. It's happened in this, this century, which is true. It happened when the NASDAQ fell 83% in the .com. So these are things that are not uncommon. They don't happen that often, but they still do happen. And it's those short time periods that can really be the difference between never having to go back to work and knowing that you'll be okay. If you're interested in that different approach, a really clean approach, a really simple approach that doesn't have you in 80 symbols that's confusing and arbitrarily having you rebalance because of the year you were born. By the way, the stock market does not care about you or me or the year you were born. But if you are interested in truly a simple, powerfully simple way, check us out. We manage money. We'd love to see if there's a fit. Thanks so much, everyone. I appreciate you, and I'll see you on the next video. Okay, bye.